Welcome to Mortgage on My Mind, where we take the mystery out of mortgages and make dreams of home ownership a reality. I'm Natalie Salins, a top 1% mortgage broker with 20 years of experience, based right here in sunny Los Angeles. If you've ever wondered about pre-approvals, appraisals, or what loan product is right for you, don't worry, I've got Mortgage on My Mind, so you don't have to. Each week, I'll bring you expert advice, real-life stories, and insider tips to help you navigate California's competitive real estate market with confidence. Whether you're buying your first home, refinancing, or just curious about how it all works, this podcast is for you. So let's talk mortgages, demystify the process, and make your real estate goals a reality. Ready to get started? Let's dive in. Welcome, everybody, to Mortgage on My Mind. Today we have an awesome guest, Jarred Talmadge. He is a senior reverse mortgage loan officer at Fairway Independent, which is another IMB, we call them, Independent Mortgage Bank, which is like Movement Mortgage as well. And I know this from other people who have come to Movement, but Fairway has a killer reverse mortgage team, because we have them on our team now, a few of them, which you might know, Jarred. But it's such an incredible topic that people really don't have the right idea about. People don't understand what a reverse mortgage is and how incredibly helpful they can be. There's a lot of really bad rumors and thoughts about reverse mortgages that simply aren't true anymore. And so Jarred's here to clear those up and explain to us what they are. He specializes in real estate professionals and attorneys and financial planners and CPAs when it comes to reverse mortgages, because a lot of times those solutions will come from those type of, financial specialists.
Right.
And he also has a book, Reverse Mortgage, an Insider Answers All Your Questions, and another book, No Place Like Home, the new way to pay for in-home care and aging in place. That's incredibly interesting, actually. But overall, he's just an expert and he has a trusted voice in the industry. And I can't wait for him to educate us a little bit here today. Welcome, Jarred. Thank you for joining us. Yeah.
Thanks for having me. Appreciate it.
Of course, of course. Well, so tell us first the myth of what people think about reverse mortgages and where it goes wrong.
So the biggest thing about reverse mortgage, people don't understand it, and I've said this for years, the industry didn't help itself when it came to that because they came up with this terrible name, home equity conversion mortgage or reverse mortgage. And so all the rumors are out there that the government's going to take your house somehow, that the bank owns your house, that there's no equity left for the kids, that they're going to die broke. It's only for broke people. This is all nonsense.
But the main one that you said is, so that people can understand, is when the person passes, the bank takes the home.
Right. And it's just not true.
And then they take the home after.
Okay. So here's how I explain it to people.
Okay.
And this is literally the easiest thing I've ever done when it comes to explaining to people. Say, okay, so you go buy a house and you go to the bank and you say, can I have some money? And they say yes, and they do that. And then in exchange, you make a payment, right? That's how a mortgage works.
Sure.
So just take bank, replace it with Fairway. It's the same thing. The only difference is that with Fairway over here, you don't have to make a mortgage payment if you don't want to. That's it. You can. Some people do, some people don't, but that's really it. Right. Everything else is exactly the same. If you pay it off and you owe less than what the house is worth, the equity is yours. If you pay it off and somehow you wind up in a situation where you're upside down, which is highly unlikely anymore with the reverse mortgage, but hey, if it does happen, and if it's an FHA mortgage, everything above 95% owed is forgiven. That's one of the advantages of the reverse mortgage, which is why everybody kind of stops and goes, wait, what was that? Yeah, you can't inherit debt. You can't pass debt on to your kids. It's like the coolest thing ever.
Right.
Nobody understands it because they're all too worried about, well, the bank's going to take my house, I'm selling my equity. None of that's true with the reverse. It's a federally backed program and you have to qualify for it. And unfortunately, a lot of people who need it can't qualify for it. A lot of people can qualify for it, don't understand what it can do for them.
Right. But there is a full qualification process. So it's not like
Absolutely.
just because I have this home, I can pull out money and not pay it just
I
because I
wish.
have it.
I wish it was that easy, but no, it's not. You have to be 62 or over. So that's
Right.
kind of a given. You have to have your house either paid off or almost paid off. You don't have to totally pay it off, but generally speaking, you have to have most of it paid off. And then you can pull a certain percentage of it depending on what your age is. The older you get, the more money you can borrow. That simple.
And why is that? Because the term
So
is less?
yeah, so what happened was in 2017, after we had the nice financial crisis, took about a decade after we did
I was
that to
going to
kind of
say,
like
which one? Yeah.
for the government to actually figure out that they should probably regulate this. So 2017, they changed the rules. And they said, it used to be that, it was like the Wild West of mortgage lending. It's like, oh, I have a house, it's worth $1 million. I can get $1 million. That doesn't work anymore. So what I tell people is I use cocktail math, right? Which is if you're at a cocktail party, you're having a conversation, inevitably I talk to somebody and I say, hey, I do reverse mortgage. And their response is, great. How much can I borrow? Great. How old are you? I'm 65. The answer is 30. 30 what? 30%. So if you think about that, what I do is I say, here's the age of the person, subtract 35,
Yeah.
and that's how much it is. And so if you owe less than 30% on your house, you could get a reverse mortgage and you could probably go up to approximately 30%. It might be a little bit more, a little bit less, but you get
Right.
the idea.
Right.
And so you'll never, even if you're 99 years old, right? Or let's say you're 100, you couldn't get more than 65% of the house, regardless of what you wanted to do. And that's because it's protectionary for not only the person in the house, what happens if they decide they need to go to a nursing home or a facility or something happens? There still has to be money left over.
Right.
So this whole idea that they're going to take your house and they're going to steal your money is just outdated. It's the problem is there's a lot of financial gurus out there that don't know this, and so they keep pushing the whole thing out there. And
Or not
then
even pushing, just not discussing, not
right,
allowing it to be an option for somebody because of
right,
fear that they don't actually understand it, you know?
correct. So if you're dealing with a senior, and let's say the senior has a cash flow problem, right? They're making their mortgage payment because it's $1,000 a month or something like that, but their mortgage is really small relative to what they owe. But they're also living on Social Security, maybe a couple $1,000s a month. Well, what can that person do that all of a sudden, I mean, what financial product could you give them that they could basically say, look, I'm going to immediately save $12,000 a year in my mortgage payments. So now you've freed up $12,000 in cash every year. So
Mhm.
cash flow is great. And then on top of that, they might get a line of credit. They might be able to do some other things. It just, when you kind of put it in that term, all of a sudden people go, oh, well, I want that. I mean, I've had 35-year-olds
Right.
say to me, I want that. I'm like, I bet. I would love to give it to you, but I can't. You're not old enough. So,
Mhm. And so, just curious, let's say somebody does have a reverse mortgage and they pass.
okay.
Does the home go to the person on the will?
Yeah. So what happens is,
There
all
is
right,
no ownership rights on the
right.
reverse
So let's
mortgage.
assume that mom is there, mom passes away, she has a reverse mortgage.
Mhm.
Okay. So first things first, the you have to notify the bank within 60 days that mom's passed away. In the meantime, keep paying your taxes and the insurance on the house and the HOA. Nothing
Right.
changes.
Right.
Once you notify the lender that mom has passed, you now get an automatic 6-month window where you don't have to do anything and decide what you want to do with the house. On top of that, if you need an extension, you get 2 other automatic extensions of another 3 months each. So basically, what happens is when mom passes away, you have up to a year to decide what to do with the house. You can either sell it, which case you sell it, you pay off the reverse mortgage, and the money is yours.
Right.
You could refinance it, in which case you refinance the house and you have a payment or you don't have a payment, depending on what kind do you, and you're done. Or what if mom passes away and she owes $300,000 and the house is only worth $200,000? The lender's going to do an appraisal. They'll find out the house is worth $200,000, and the heirs can go, you know what? I don't want to deal with it. And they can walk away. No debt, debt's forgiven,
The
house
debt
is sold to a
dies
bank,
with the
and that's it.
house. And that's crazy. Now, would you guys really give a full 300 when
No,
it's only worth two? Right.
no.
Like I mean, that
But let's assume she got the loan in 2017. So these protections were in place. And she passes away in 2027. there is a possibility that the line of credit that she comes with that mortgage could exceed the value of the house. It is entirely possible. So let's say she gets the house and she gets a $200,000 line of credit in 2017. And over the years, because she had a high interest rate or she had some high growth rate, let's say that that line of credit grows to $400,000, but at the same time, the market crashes and her house goes from being worth 400,000 to 200,000. Well, she still
Right.
has the $400,000 line of credit.
Right.
Congratulations. She should spend every dime of it.
Right.
Because what happens is that money is going to be forgiven by the government if she passes away, if she's underwater. It's just one of
Mhm.
those weird loopholes that's created in the reverse mortgage field that when people start learning about it, they go, "Oh, wait a minute, that's not what I was told."
Right. Right. Okay, so now tell us,
Mhm.
because I know a bit about it, of course, even
Right.
though I've only done like two Heckams in my whole life. And it's really because I broker them out because I don't like to not know everything that I'm about to sell to
Right.
a client. And
Right.
it's much easier to get a specialist to do
Mhm.
this for clients. So what are the options? I know there are different payout options. So you can choose
Right.
like monthly distributions, and then the loan gets bigger every month. I think regardless, negative amortization is happening, right?
Correct.
Every
Yeah.
month. And then what are the options to take lump sums? Like what does that look like for a client? And
So,
discuss negative amortization.
okay. So 99% of reverse mortgages or HECMs
Yep.
are considered adjustable rates and they have a line of credit. How that works. So you basically say, we're going to use, for argument's sake, let's say the house is worth $1 million.
Mhm.
And you can get a 350, you get a loan and you wind up with a $350,000 line of credit.
Mhm.
Your choices are very easy. You can do nothing, in which case that $350,000 is going to sit there and it's going to accrue. And basically, what's going to happen is because it's like a credit card, you don't have to pay, right? Because you don't have a balance on it. So the line of credit will increase by half a percentage above the interest rate for as long as you have it. So if
Mhm.
it's 7%, that line of credit next year, when you don't use it, is going to go up by 7.5%. So you can see where if you don't use it, and what I recommend to clients is if you can get a reverse mortgage at 62, which is what I did for my mom, I said to her, get the line of credit and don't use it. She says, why would I do that? And I said, because that $350,000 line of credit that we're starting to talk about may increase over the next 10, 15, 20 years. All of a sudden you find yourself at 82 and maybe that line of credit of 350,000 is now 500,000, right? It doesn't
Mhm.
matter what the house is valued at. The house is completely irrelevant to that figure. That $500,000 is now yours. You could advance it as a monthly payment. Say, I need payments every month, so please give me $2,000 a month for whatever. You could decide you want to advance some of that as cash and say, I want a lump sum right now, and I want a line of, I want a payment coming to me every month. You could take it
So you
all at
could
once if
like
you want.
take 200 out of it
You could take any number you want out of it and let the
and
rest sit
buy a
there.
second home in Palm Springs or in Florida where your
Yes,
children are, whatever, and still get monthly payments to pay it.
correct. And so I had a client once who lived in Colorado, wanted to buy a condo in Arizona to live there during the winter because, of course, Colorado is kind of snowy. So we did a reverse mortgage. We took out all the money. She took that money. She went down to Florida, bought a small one bedroom, one bath condo, paid cash. So
Love
now
that.
she has
Yeah.
her house that has a reverse mortgage on it, which she has to live in 6 months and 1 day a year. But that's literally you get a letter in the mail that says, "Do you live here?" You just say yes.
Mhm.
You won't hear from them again for another year. Meantime, for 5.5 months a year, she packs up her car and her cat and she drives down to Arizona and she goes to live in her condo in Arizona and she spends the winter there and then comes back. And now
Right.
she has two houses instead of one. And of course, one of them is appreciating with
Of
no
course,
mortgage. The other
with
one's appreciating
zero
with
lien
reverse.
against it. Yeah. And she can then get monthly distribution to
Correct.
pay the mortgage, right?
Correct. If she wanted to, yeah.
Right. So
Now, you
even though
had
she has to qualify for it, so she's
correct.
probably earning money in some way in order to pay for it.
There's another complication. So two things. One, you had asked about negative amortization.
Yes.
The
Because I was
negative
going to say all
amortization,
of this for a pretty fee, though, right? We can't
right.
forget that. So,
Well, the negative amortization is basically just saying instead of making that payment in your lifetime, it just gets tacked onto the mortgage and you pay it when you pass away. So that's literally all negative amortization is. Now, what she could do with it, now we were talking about this, and she says, okay, so she goes down and she has this house down there and she has this house up here. In order for her to qualify to do the reverse mortgage, they want to see some kind of income. That could be Social Security. That could be investment income. What they're looking for is, can you pay the tax? Can you pay the insurance, the HOA, and can you eat? If you can meet those 4 criteria with the money that you have, you basically qualify, because the qualification is if you based on your age, not your credit.
How do you determine can you eat? Is that just part of a debt ratio?
It's a ratio issue.
Okay.
Look at it, you put the numbers in and the computer will spit it out. Well, when it says, it's called a financial assessment, and what you have to do is, this is again part of the 2017 revision. They are going to ask, you're going to be asked a bunch of questions from your reverse mortgage loan officer, and they're going to ask you what your expenses are. And then they're going to throw it into a computer and it's going to calculate it out, and it's going to take out your payments. If you have a mortgage, it's going to take that out. It's going to say, look, if most people in a situation where they have a mortgage and they're paying it off to do a reverse mortgage are going to qualify, because if that mortgage payment's going away, well, there's your money to eat and take care of yourself. And so the reverse mortgage not only creates capital for you to have later or whenever you need it, but it also improves your cash flow. So one of my first book that I wrote was called Too Good to Be Free, and it was why a reverse mortgage can improve your life. Now I've got to look at my own book to know what the title was.
Okay. Is it the one that I have that Insider answers all your questions?
That's a separate book, but this is a
Okay.
reverse mortgage can improve your life, your cash flow, and pay you too. That's where the title was. But that's the idea, is for people who are house rich, cash poor, this is a magnificent product. And it could literally change everything. And I've had people where I've had a 92-year-old grandma who decided she wanted to pay for her grandson's medical school. So she took out a reverse mortgage, took out all the money, handed it to him as a check at graduation, and he nearly fell over because his grandma hadn't told him she was going to do it. She just knew he got accepted into medical school. She comes up, hands him a thing. He says, okay. And she says, no, you have to open it now. So he opens the envelope and it says, congratulations on graduating school. Here's medical school paid for. It was a $250,000 check. Now,
Right.
I haven't been 22 in a long time, but I'm pretty sure that if somebody handed me $250,000 at age 22 to go to medical school, I would have been floored too.
Well, let's put out an opposite view of that, because I have people handling and everything, of course. So don't you really have to put side by side how much it's going to cost? Because that loan rates on reverse mortgages are higher. The loan gets bigger every year, of course.
Yep.
And that can be very costly compared to getting a student loan, which those interest rates are never quite as high as a reverse mortgage interest rate.
You could.
Right? I mean,
However,
just in thinking about like paying somebody's student loan debt, but then having like major debt after because of it.
Sure.
Compared to the
Let's play that scenario out.
Right.
Yeah, let's play out that scenario. So let's say
Talk about it.
we're talking about a $500,000 house. Pretty reasonable. Most of mine are around here somewhere.
Okay.
Okay, so let's talk. So you have a $500,000 house, and you're saying, well, I could take 30%, right? So
Okay.
I take a couple $100,000.
Real quick, what is an LTV max?
It is to take the age of the lowest person, subtract 35. Whatever that number is. So if they're 65 and you take off 35, it's 30. So the 30% LTV is max.
Wow. Okay, everybody. LTV means loan to value.
The value, which means how much money can you borrow? So if you're 90, right? So we're going to take off
35 is 65%.
Correct.
Oof. So you really can't take out too much.
No.
They really don't let you. You're never going to hit that 100%.
Oh, never. Now, you have to have done it before 2017 to do that. So unless you have a time machine, you're out of luck.
Right. Yeah.
But the reason for that is, so let's say you have the house mortgage to 30%,
right?
Right? The house is most likely going to go up in value over the next 5, 10, 15 years. So think of it as, yes, the amount of your borrowing is increasing, but the amount your home is growing in terms of value is probably going to outstrip the amount of money you're getting compounding in interest. So if you think about that difference between what you owe and what the house is worth, of course, is your equity. So even if you borrowed the maximum amount of money, it's so unlikely that you're ever going to trigger something that would cause a problem because you're really not borrowing that much. So now let's look at this and say, okay, so if I borrow 30% on a $500,000 house, so I'm borrowing $150,000, and let's say I'm accruing at 8% a year, 7% a year, whatever number you want to put in, it really is relevant, but let's throw it out there. The question is the house growing faster than that? Well, probably it is. So now there's all kinds of tax ramifications to when you pass away and you sell the house and your estate does that. So I would recommend in that situation talk to an accountant because there is tax ramifications to doing this. But compare that to student loans where right now we've gone from the situation where everything was on hold from COVID, and now the government is flipping completely the other way and saying, well, now we're going to collect everything. What if you were in a situation where you couldn't pay those student loans right now?
Right.
Now you're threatening your credit, your availability to get your federal tax returns, your debt, all kinds of bad things happen. But here's the thing. I hear a lot of times that everybody is worried about what is the cost of a reverse mortgage. Everybody freaks out because they say, oh my gosh, it's so expensive. Well, compared to what? Right? If you a reverse mortgage generally costs between 3 and 3.5% of the value of the house. Part of that is because a big chunk of that, 2% of that 3.5%, so basically 2/3 of that money is for what's called mortgage insurance. You're a mortgage person. You understand what mortgage insurance is. On the forward side for FHA, it basically gives you a guarantee that somebody with a lower amount of down payment can get into a house. But you're buying an insurance policy to make sure that the lender doesn't have a problem. With the reverse mortgage, it's the exact same thing, except it benefits you, the borrower, not the government. Okay. How do I mean by that?
Yeah.
You take out mortgage insurance because it's required as part of the reverse mortgage. And we have 2008 happen all over again. So we see home values drop 60, 70% overnight, right? You have a reverse mortgage, and side by side, you have somebody who has a forward mortgage. Okay. So you're 65 years old, you have a forward mortgage, you miss what? 2 payments, 3 payments, and the bank's knocking on your door, pop, pop, pop. You're out. Sorry. Too bad. And you're sitting there going, yeah, but everybody else's values are dropping. We're in this terrible situation. The world is ending, and I'm not going to have a place to live. And what does the bank say? I don't care. Too bad. Same scenario with a reverse mortgage. You have a reverse mortgage and you don't make the payment. What happens? Nothing. Nothing. It doesn't matter if your house drops to $5 and you owe $200,000, $300,000, $400,000. It doesn't matter. The bank cannot foreclose on you as long as you do 3 things: pay the taxes, pay the insurance, pay the HOA. That's it. They have no choice. And then
even if you're not paying the mortgage, but then again, it's accumulating monthly, right?
Correct. So let's play this scenario out. Let's say you're underwater $200,000 on your house and you die, right? So now what's the heirs? Every heir I've ever talked to goes, oh my gosh, I owe 200,000. No, you don't.
Right.
The debt dies with the borrower.
Right.
So you cannot pass on that debt to your heirs.
Right, but we've already discussed that the idea that it would ever be underwater is extremely rare and basic.
It's so unlikely, but it is possible.
Right.
And when you start
because
talking
even if it were 2007, when so many homes lost 50% of their value.
And how many of those homes could have been prevented from being lost if they had a reverse?
Well, I don't think there were tons of 62-year-olds buying like fiends back then. I'm sure there were a few.
There were a few, and there were
even
people that,
still, if it's 62 and they can only take 30% of
that's
the
now.
value.
That was never back then. That wasn't the case. Back then they could do.
Oh, I see. I see.
So.
Oh, I see. Okay, that makes sense. But even still, like everybody that I was financing at the time were mainly people who never thought that they could get in, shouldn't necessarily have gotten, didn't have the docs to get in, and got in. And
got in anyway.
And then got in anyway. That was really like 90% of it, the chaos. But okay. And so then how can a realtor or the real estate industry take advantage of this? Like,
I love this question.
Yes. Okay.
Okay. Let's deal with a client who is over the age of 62. So we'll make them, let's say 65, right? So just for round numbers.
Okay.
So 65-year-old says, you know what? I have this $500,000 house. I'm going to sell it. And so they sell the house. And now after expenses and whatnot, let's say they have $450,000 in cash. They go to the realtor and say, okay, Mr. and Mrs. Realtor, I have $450,000 in cash. I do not want a mortgage payment. So what does the realtor do? They say, okay, great. We're going to go show you a house for $400,000 because they want to have some extra money left over and whatnot. And the client looks at the house and goes, oh, I don't like this. Okay, so what are your choices? You can move somewhere else, which they probably don't want to do. They can buy a smaller house, which if you know anything about how people buy houses, nobody ever wants to move down in size. They always want to move up. Even if they say they want to move down, they don't, right?
Sometimes. My retired people sometimes want to.
Right.
In LA, you could have a huge house with 3 kids and they've all moved out and you want it to.
Correct.
But it's not. Right.
Let's assume for a second that somebody who has a 3-bedroom house doesn't want to move into a 1-bedroom, 1-bath condo.
Certainly.
Right?
Yes.
Because that's all they can afford. At $450,000, that's all they can afford. Yeah. Now, enter the reverse mortgage. Remember, that person can finance up to another 30%. So let's add 30% to that 450. And now, let's say if they're looking at houses at 450 and they go, oh, I just don't like anything. Now, what if the lender comes in and says, you know, Mr. and Mrs. Client, you're stable, you have Social Security, you're over 62. By the way, did you know that you have $450,000 you want to put down? You can buy a $600,000 house. Put down $450,000 and you still don't have payments for the rest of your life. Now, all of a sudden, they can buy anything from $450,000 all the way up to $600,000. Now they have a lot more choices to make.
And that's only if the property value is at over $1 million or so.
No, that's the value at $650,000.
They can take $450,000?
They could literally say, I want to buy a house for $600,000, put $450,000 down, finance the rest with a reverse mortgage, and never have payments in life.
But the $450,000 is coming from the current home. Is that what you mean?
It's what's remaining of the equity from their current home. So if they sold a $500,000 house and they net $450,000,
right?
Take that $450,000 and put it as a down payment. By putting down $450,000, they can go up to $600,000. And basically, so they're basically taking out $150,000
They can basically get 30%
more house,
a mortgage.
Right, with still no payments.
Right. Exactly. As long as, and this will work because very rarely do we find something for $600,000 in LA. So the same will apply to something like $1 million.
Yeah. So if you do $1 million, right?
Let's get a 300 loan, basically.
Yes. So $1 million house, and they can buy it with a reverse mortgage. They're looking at $1.3 million, which, as you know, will change everything in terms of where their price point is, because they can find something for that and still not have to make a payment.
Right. So let's talk about real quick. So they get a loan for 300 and they don't make payments.
Correct.
How much does it go up monthly? Because it's not just the mortgage payment. There's a built-in padding that it goes up as well, right?
No, in this case, it's just $300,000. Let's say the interest rate, let's say it's high and 7.5%. That's $22,500 a year, which means their mortgage is going up about $1,800 a month. That's the balance, right? So if you look at it, you say, okay, it's going to come up about $1,875 a month. So call it $2,000 more or less. And so it's $24,000
at the end of the year, all of the payments that they should have paid just get built in, but there isn't a padding in there. It's only the mortgage payment.
And that's it. And so what happens is,
so great.
A house worth $1.3 million that you borrowed $300,000 on. Do you think the house is going to go up more than approximately $20,000 a year?
Right.
Then who cares what the interest rate is? Because
even in 10 years, it's gone up $220. In 10 years, now they owe $520.
Right. So what is the house?
And in 10 years, the house will be worth $2 million.
Yeah. So
and they haven't had to make one payment.
Right. And they have what? They've basically made $1 million in equity.
Glorious. Well, they put $1 million down.
Right. But
so
at any time during that point, remember, they're getting older. So at some point in the future, they could always refinance it and decide they want to take a line of credit out. And because they're older, they qualify for more. The house is worth more money.
Right. They do.
And as a result, they can get more cash.
They do another HECM.
Yeah.
they refinance out of that one into another.
Into a new one, get more money.
Or what I've done in the past was I've rolled the mortgage so that you don't have to deal with it. I've rolled the mortgage into the kid's name, and then the kids go on title and they refi it into their name as a standard loan. And they get out.
Yeah, I was gonna say it's a standard loan because they
and they get out, and then they get out of the reverse.
Right.
Yeah.
Right.
That's glorious. I mean, that's brilliant. If you
Yes.
you really look at it that way, I definitely should talk to some of my agents about that,
It's definitely one of those things that when you actually get somebody who gets into the nitty-gritty of the understanding of how the thing is, the HECM was never meant to do that. It's just how the loopholes evolved over the last 30, 40 years.
Right.
And so when you look at
Was
that,
Heckham like what was his name? Oh man, what was that actor's name that did all the reverse mortgage?
Tom Selleck.
Tom Selleck.
Yes.
I used to like him. So the Tom Selleck reverse mortgage days, were those the days when the bank had rights to the property?
Nope.
Where did that come from then? There was
Okay,
never
so where that comes from, I'm not going to say the person's name because I don't need to get sued. But there is a financial guy out there who basically is spouting off information from 2012. Okay.
But that's what I mean. So from 2012?
Prior to 2017, think of it this way. Prior to 2017,
Mm-hmm.
there were no rules. So if I was an unscrupulous banker and I called you up and you're over 62 and I said, hey, do you want 100% of your money? And you said, yeah, that sounds great.
Okay.
And you signed the paperwork, right? And all of a sudden you have $1 million house, you get $1 million in cash, which means you have no equity left.
Right.
And you have that negative amortization going on. So now you literally are owing more than the house is worth. And then all of a sudden you can't pay your tax. I mean, the thing was, most of the time, it wasn't the lender doing it. It was the county or the insurance company. It usually was the county because the insurance company doesn't care, because you'll either insure it or you won't. And if you don't, and the house burns down, you're gonna live in the backyard.
Right.
The county wants their taxes. And so let's say you took out $1 million on $1 million house, you had no money left, you went to Vegas and you spent it all, which happened. And then 3 months later, 6 months later, you get a tax bill that says you owe $20,000 in taxes. And you said, I don't have it. And they said, okay, well, then we're going to foreclose on you. And what would happen is, inevitably, what would happen is grandma would get thrown out of the house. All of her stuff would be on the front lawn, and she'd be screaming that the mortgage company threw her out. The mortgage company didn't throw her out. The county did.
So legitimately, it was never a thing that the mortgage company had rights
Never
to
a thing.
the home.
No.
Never?
Never. It has never
What?
actually been a thing. The thing is, like I said, there is a financial guru out there who's been touting paying off your debts. Debt is bad. It's horrible. You can figure out who this is if you want. But he basically uses these graphs from 2012 and says, well, look, if you borrow 100% of your house and then your house goes up this way and your interest rate's higher than this is why debt's bad.
Barry Habib?
Nope.
I was like, because he's a guru. He's like the best.
Right. But
Yeah.
here's the thing, and this is where I kind of explained.
But he also is like, debt's bad, refinance, regardless
Right.
of high rates. Yeah.
The difference is gurus will tell you, go do this, do this because it's bad. But then you ask them a question, they go, I don't want to answer that, or I can't answer that, or you go do your research, right? Whatever. An expert will actually tell you, A, where it comes from, and B, where they can prove it, and C, why it happens. And so think of it this way. The reverse mortgage today has so many built-in things to protect the borrower, not the bank. So the borrower has to go through financial counseling. Financial counseling means basically I could turn around and give you a proposal tomorrow on a reverse mortgage. And you could say to me, I want to do it. And my answer would be, that's great. But you have to go to third-party counseling. And that is FHA does third-party counseling. You make an appointment, takes about an hour, costs $100, $150. And they will go over everything that I should have gone over and make sure that what I explained to you is the same thing as what you're actually getting. Now, part of that is to make sure you understand what you're doing. The other part of it is to make sure you understand that you are competent enough to do this. I once had a client who went to counseling, and the loan was perfect for him, but he's talking to the counselor, And the counselor says, well, what do you think? And he says, well, I have to talk to Bob. The counselor says, oh, Bob. Who's Bob? Son? No. Husband? No. Friend? No. The counselor's starting to get worried.
Mortgage lender?
PA, mortgage advisor. She's like going through all these things. Can't figure out who Bob is. Finally, he looks and he leans into her real close. He says, Bob is my other personality, but he doesn't know about any of this. Wall comes down, can't do the loan. Because he was not mentally competent to understand what he was doing. Can't do the loan. The thing is, it's highly regulated. It regulates how much the mortgage insurance premium is. It regulates how much I could charge. It regulates what the third-party fees are. All of this is regulated. So that's why I tell people, I'm like, look, you may think of me as a salesman. I'm not, okay? Because all I do is I educate people and I say, this is what a reverse mortgage can do for you. Now, do you want to qualify? Great. Here's the information. We got to go through the first hurdle, making sure you can qualify. The next hurdle is you have to pass counseling. If you don't pass one of those two things, it doesn't matter what I want, doesn't matter what you want, you're not getting the mortgage. So you have to follow all these things. And then after that, there's only a limited amount of money that can be charged for that. Because trust me, I would love nothing more than to charge more for this, for larger loans. I can't. It's not allowed.
Right.
And that was a reaction to the 2007 crash where the government came in and said, maybe we shouldn't let everybody borrow 100%. It's probably not a real good idea. And so they cut it down.
Right.
And so the thing is, I tell clients, yes, interest rates are relatively high compared to what they've been for the last 15 years. They were also relatively low compared to what they've been for the last 100 years. So if interest rates return to 3% and you have a reverse mortgage in the 7s, refinance it.
Right.
Get better.
Yeah. I think people think that they are more stringent and harder to get in and out of than they are. But if it really just works like a standard loan.
Here's the thing. You want to get out of your reverse mortgage? Sell your house. Refinance it. Just like a regular mortgage.
So yeah, exactly. Exactly. I mean, this was enlightening. Thank you so, so much. I really, really believe it's incredibly good information. And I really think that my listeners will enjoy it and get a ton out of it. In fact, I think for the first time, I might send it to a few people because of how informative it is. I really think people need to hear it and understand it and not be so afraid of it. Of course, I'm sure this is a daily script and conversation for you because the information out there is daunting and just so incorrect. It's crazy.
It comes down to basically three things. Okay. You can tell me any number of reasons why somebody either wants or doesn't want it. But when it comes down to it, people want reverse mortgage for three reasons, two of which are most of them. I'd say 90% cover the first two. A, they want to get rid of their mortgage. They don't want to pay their mortgage payment anymore.
Right.
B, they want cash or they need cash. Well, you take out a reverse mortgage and you eliminate your mortgage payment, you immediately create cash flow, and retirement is all about cash flow. The third one is tax purposes, and most people aren't in that position. That's it. It's those three things. Everything else is kind of like irrelevant.
Right.
And when you sit down and you talk to somebody and you say, look, let's take all this hype that you've heard and put it aside. Let's talk about the reality of it. The reality of it is, if it works for you, it's a great situation. And if it doesn't, it doesn't. But you can't go into a reverse mortgage and say, well, this isn't going to work for me, and the lender does it anyway. It doesn't work that way.
Right.
So.
Right. I love it. I love it. I love it. Thank you so, so much. You were incredibly informational, as I said, and lovely. And I really appreciate you coming on and being such a voice of reason about this topic today. And I certainly look forward to speaking with you soon. And your information will be in the whatever it is below, of course. Everybody, please reach out to Jarred. He is a wealth of knowledge, and clearly, if reverse is what you are looking for, he's the guy to go to. Thank you so much.
Thank you.
Thanks for listening to Mortgage on My Mind. If you're ready to start your mortgage journey or have any questions, I'd love to help. With 20 years of experience, I make the process as simple and stress-free as possible. Check the show notes for my contact info, and don't forget to subscribe, leave a review, and share this podcast. Until next time, I'm Natalie Salins, here to help make your real estate dreams a reality.